Corporate finance practice problem using OneNote. Convertible bond, pure bond value versus market price problem number 1. Get ready, it's time to take our chance with corporate finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side, the Practice Problems tab, down in the 1920 Convertible Bond, Pure Bond Values versus Market Price Problem 1 tab. Also note, when using OneNote, look at the Immersive Reader tool. Presentations, also down in the text area. Same name, same number, but with transcripts. Transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we have our information up top. Calculations then on down below. We're looking at those convertible bonds, bonds which have the option of being converted into some form or quantity of common stocks. The information on the left, we have the convertible bonds outstanding, market price at that $1,300. That's what the convertible bonds are selling for. They're selling at a premium given the par value is at $1,000, coupon rate 15%. They mature in 19 years. The conversion ratio, meaning the ratio of how many shares you could get for the bond. So one bond gets us 31 shares of the related common stock. The market price of that common stock, so in other words, if we were to take that bond and convert it to the common stock, that common stock currently selling on the market for the $40. The interest on the bonds are semi-annual. And then if similar bonds that are not convertible are yielding 12%. So we're going to think about the pure bond value then as well. So if we have these convertible bonds, notice kind of our problem is with valuing these types of things is the convertible bonds are more complex than other types of securities because they have that conversion feature and therefore can be in essence bonds or common stocks depending on what's going to happen in the future. And of course they have the option of conversion in the future, which gives you that benefit on the investor side of things to be able to take advantage of it if the stock price goes up and keep the bonds if they remain the same. But when we value it, we can look at kind of two sides. We could try to take this thing apart, look at it from the side of the valuation of the stocks if we were to exercise the conversion feature because we know what the stock prices are because they're currently trading on the stock market. Or we can take a look at the other side, the bond side, and think about what would related bonds be going for if they didn't have the conversion feature to try to look at more simplified things that we can tie down a little bit easier to the market and then figure out kind of what the value of the conversion feature is on the more complex security. So let's go through that process. We got the conversion value. The conversion value we're going to say is the conversion ratio of the 31 shares. That's how many shares we can convert the convertible bond into if we so choose. The market price then is at $40. So if we convert the bonds to 31 shares at $40, we would then have a value in stocks of the $1,240. That's one way we can kind of try to value this because, again, we know the stock market price of the stocks. So if we converted it, we could say, all right, the conversion value, if we were to convert at this point in time today, obviously, things could change, and the speculation of what's going to happen in the future would impact our decision-making on the bond. But today, we're at the $1,240. Then we have the pure bond value, which would be calculated as the present value of the interest payments and the present value of the face amount of the bond. Now, I'm not going to go through the calculations here. We went through a whole section on bond present value calculations. And we've also done a whole kind of section on present valuation calculations in general. So if you want to go back to those to just work on it. We also do this in Excel. So if you want to see this in Excel, we'll do these present value calculations in Excel. But we're basically just looking at similar bonds here. The idea being this bond is special. It has a conversion value to it. I can't compare that to other bonds with that conversion because that's kind of more of a thing that's not in a lot of other bonds. So what we can do is compare it to something that is a standard bond and try to figure out then what the value would be on it and then figure out the value of that conversion feature. So if we look at similar bonds, we got the rate at the 12%. So if we use that 12%, it's a semi-annual bond and we calculate it. We used Excel to do the present value calculations here with it. We would be present valuing the interest streams. The interest payments then would be the par value of the 1,000 times the 15%, but it's semi-annual, so it would be divided by 2, so it would be that 75 for every 6 months that we'd have to present value that stream of payments over the 19 years, which would be in 16 6-month payments. 19 times 2, 38 periods. So again, we won't do that here, but you can look at it in Excel if you would like to. So the present value of the interest payments, if we would do that process using the 12% as the market rate and the 15% as the coupon rate, would be the $1,113.45, and the present value of the face amount of the bond, meaning the present value of that $1,000 if we pulled it back using the 12%, would be the $109.23. So the valuation of the bond, adding those up, would be the $1,222.69. So if we look at the conversion premium, then that's simply going to be the comparison between the bond price, the bond is currently selling for $1,300, and the conversion value, which we calculated at the $1,240. The conversion value, remember, is on the stock side of things, where we imagine the conversion taking place, comparing the price to the value of the stocks. That means that if we were to buy the stocks and convert them immediately, we would be down basically $60 if we otherwise just would have purchased the stocks outright. But of course, the reason we would do that possibly is because of the speculation into the future to see what would happen, which is of value to the investors. So we could also look at the difference between the pure value of the bond and the market price, meaning the market price is at the $1,300 once again. The pure value of the bond, if there was no conversion, was that $1,222.69. So that would give us the difference of the $77.31. So now let's think about, well, we also could think about this factor. We could think about the convertible bond yield. The convertible bond yield, in other words, what interest rate would this need to be? So we used a 12% interest rate. What interest rate would be needed here in order to get the end result of the bond calculation to be the $1,300? And we basically use goal-seek to do this, which would be kind of complex to do from a mathematical standpoint, because you do have two kind of factors that are going into the pure bond value. Again, we talk about this in the bond section, so I won't go over it in detail. But the idea here, if you do it in Excel, and we'll show it in Excel, if we have these formulas that do the present value based on this cell, which we could start off as 12%, then we could figure out, okay, what would the percent need to be in order for the bond value to be the actual market price of the $1,300. And we could basically use a trial and error goal-seek kind of method to do that, which we'll do in Excel if you want to check that out. And that would be the 11.16. So 11.16 would be the percent that would be needed in order for the bond value to equal the market price that it's currently selling for. So these are all attempts for us to basically take this kind of more complex security and try to value it. Now, obviously, it gets quite complex when you add even a little bit of complexity, because the beauty of things like stocks and bonds is that they're fairly simple and straightforward and standardized, which means that you can compare them quite easily across the market. When you add, obviously, options, and you add a lot of complexity to something because you don't have the ability to compare it to something else directly. So what you can do is try to break it down and break down what you can compare. And we can compare, of course, the stock value. We can compare to just pure bond values, and that can help us to kind of back into possibly the valuation of the ability to have the conversion.